For most people, the homes they own are their biggest investments, and a special tax exclusion available only to those who sell their personal residences make this investment even more valuable. I'm the Tax Geek, and here are the tax consequences of selling your home, oversimplified. As I've mentioned in other videos, whenever a capital asset is sold for more than its basis, the result can be a taxable gain. For assets held for more than 1 year, this is considered a long-term capital gain and can result in capital gains tax. However, if you sell your personal residence, you are allowed to exclude much or all of the gain from taxation. Married taxpayers who file jointly can exclude up to $500,000 in gain from taxation, and all other taxpayers may exclude up to $250,000 in gain. To see how this works, we first need to define what a personal residence is. To be eligible for the personal residence gain exclusion, the property has to meet two tests: an ownership test and a use or residence test. The ownership test is simple. You must have owned the property for at least 2 out of the last 5 years leading up to the closing date of the sale. For married couples filing jointly, only one of the spouses needs to meet this test. The residence or use test is similar, but not as simple. Essentially, you must have used the property as your main home for at least 2 out of the last 5 years. To meet the use test, the 2-year period doesn't have to be consecutive. As long as there's at least 730 days of use during the 5-year period, the test is met. If you have one home, this is easy to determine. But if you have more than one home, you have to determine which home is your main home. Only one home can be your main home, and this is usually defined as the home where you spent the greater number of days. However, what is considered your main home can also be defined by other facts and circumstances, which can include the address on your driver's license and vehicle registration, the address on your tax returns, where you vote, and where you work or conduct business. Here's an example. Danny and Jacob are married and have 2 homes, a condominium in Boston and a lake house in Webster, Massachusetts. They love their lake house and actually spend more time there than in Boston, especially since they can telecommute. However, the Boston address is on their tax return, they vote in Boston, and their jobs are in Boston. The Webster address is on their driver's licenses and car registrations to take advantage of lower car insurance rates. As such, given the facts and circumstances, their Boston condominium would be considered to be their main home. As is usual with the tax code, there are several exceptions to the ownership and use tests where you can claim the full exclusion without meeting the tests. Exceptions are available for members of the armed forces, job-related moves, health-related moves, if either spouse died, the spouse is divorced or separated, or even if a sudden change in employment or income made the dwelling unaffordable. If you don't qualify for an exemption, you can claim a prorated exclusion amount based on the days of ownership or use. The exemption amount is prorated according to the ratio of days owned or used to the necessary 730 days to qualify for a full exclusion. Here's how that works. Emily purchased a home on April 15, 2024 for $257,000. Wishing to trade up to a larger home, she sold the home for $335,000, closing on September 20, 2025, giving her a gain of $78,000. She does not qualify for an exemption to the ownership or use tests. She owned the home 523 of the 730 days needed to claim the exclusion. 523 divided by 730 gives us 0.7164, which is then multiplied by the maximum exclusion of $250,000, giving her a reduced exclusion of $179,100. Since the gain on the sale was only $78,000, she is able to exclude the entire gain from taxation. So all that being said, how do you calculate the gain on the sale of a personal residence? You start by determining the selling price of the home. This can be found at the top of your settlement statement. This is also the amount that is reported to the IRS on Form 1099-S. Keep in mind that this is not the cash you receive at closing. In fact, any mortgage you may have on the property does not affect any gain on the sale. From the selling price, you get to subtract any selling expenses. This can include any real estate commissions or direct advertising expenses, legal and recording fees, or closing costs that you reimburse the buyer for. After these subtractions, you have the amount that is realized. Next, you determine the basis of the home. I've explained the concept of basis in other videos, but here is a recap. You start by taking the original purchase price of the home, or if you constructed the home, the cost of the land plus the cost to construct the buildings and other land improvements. To this amount is added any closing costs paid when the home was purchased or constructed. Next, you add the cost of any permanent improvements you made to the property in the time you've owned it. According to the IRS, an improvement adds to the value of your home, improves its useful life, or adapts it to new uses. Based on that definition, there is a lot of room for interpretation when it comes to repairs versus improvements, so shown on the screen are examples based on my own professional opinion. Once you have the total basis, it's now time to adjust that basis. Adjustments can include any energy-efficient property credit or clean energy credit that was previously claimed, the dollar amount of any damage to the home offset by any insurance reimbursement, and if you received any payments for granting an easement or right-of-way, those payments are also subtracted as an adjustment to basis. Now you have an adjusted basis. The amount realized is then compared to the adjusted basis, and if the amount realized is higher than the adjusted basis, you have a gain on the sale of the property. If this gain is less than the exclusion amount, you have no taxable gain. If the gain is greater than the exclusion amount, the difference is a taxable gain. This gain is subject to long-term capital gains tax as long as the property was held for at least 1 year. If the amount realized was less than the adjusted basis, the difference is considered to be a non-deductible personal loss, since losses on the sale of personal use assets cannot be used to offset other income. How is all this reported on a tax return? You'll find that out in the next video. Links to additional information and resources can be found in the video description. In the meantime, if you found this video informative, please give it a like and subscribe to see more oversimplifications of our increasingly overcomplicated tax system. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.